Are you choosing a mutual fund scheme based upon its past 1 year returns and investing your money into it? If you say yes, then probably you will be disappointed by staying invested into the same schemes. It's because the past performance in the mutual funds does not guarantee you future returns. That means the scheme which has been in the top of the chart in terms of returns, it is more likely to be at the bottom of the chart in the coming years. So it's always better if you see the consistent performance of any mutual fund scheme, at least for the last 5 years, how it has performed, and invest your money into it. Lesser the volatility in returns, better it is for your portfolio. But apart from just the returns, there are various other factors which are important and needs to be considered before choosing any mutual fund scheme. Like, what is the objective of the mutual fund scheme, and whether that objective is aligned with your objective of starting your investments in that particular scheme. Then what is the risk level of the mutual fund scheme, and whether the risk level is suitable for your risk profile or not. Then who is the fund manager of the scheme and how the scheme has performed under his management for the past years. What is the total funds he is managing through that scheme, and what is the total expense ratio of the scheme. Then you have to compare the performance of the scheme with respect to its peers and also with respect to the benchmark. Like, what is the beta and standard deviation of the scheme, which denotes how the volatile the returns can be. What is the Sharpe ratio and Treynors ratio of the scheme, which shows what is the risk adjusted returns given by the scheme. What is its Jensons alpha, that means how much more returns this scheme has been able to give above the benchmark. What is the portfolio turnover ratio of the scheme, whether it has been following the investment strategy as mentioned in its scheme information document, whether any hedging techniques has been used for protecting the portfolio against the market volatilities. How about the portfolio diversification, whether it is too diversified or too much concentrated. Depending on the type of the scheme, what about the exit load of the scheme, and what about the tax impact on the returns that are being generated. After analyzing all these parameters, the best mutual fund schemes are chosen. So it's not that easy for an individual to pick up the mutual fund schemes which can give you the consistent returns over a longer period of time. So I recommend everyone to start your mutual fund investments under the guidance of a mutual fund distributor or a mutual fund advisor who will understand your needs properly and recommend you the suitable mutual fund schemes which suits your profile and give you the consistent returns over the period of time, rather than choosing the mutual fund schemes on your own. Only the advisor can give you or generate your portfolio the desired alpha, that means the higher the returns on your portfolio, because of his knowledge, skills and his experience.